I'm
Afternoon.
Tyson Halsey. I have an investment firm, Income Growth Advisors. I also have a startup which is involved in the energy transition, Optima Process Systems. So I know something about venture capital in the energy business and also about investing. We have a great lineup. I'm going to MC it. We're going to start with it. Jennifer told me it is Women's Month, so we're going to start with the ladies first and then go to the men. I'm going to quickly introduce everyone, then they're going to introduce themselves to pick up what I left and then talk about what we've already discussed. So on a high level, we're going to start with Heather Gilker. And Heather worked with Fidelity, working with 100 million and billion-dollar family offices, now as a managing director at Pickwick Capital. And she's going to talk about an old school carbon capture technology roll up where they have some proprietary technology and hope to really be disruptive. Then she will be followed by Jennifer Warren, who has spoken here several times. She is a writer and she is well versed in the energy transition technology. She's a native of Texas and understands oil and gas well. Will be then followed by Bate, an engineer with executive banking experience in the energy space. He is working with us on a small project of possibly selling some natural gas properties up in the Utica Marcellus, but he has his own company, EP Valuations, and has a rich portfolio, and he'll talk about what he's going to do, but he will be talking about the ESG, Bitcoin miners, and E&P partnering with other value-added entities. And then lastly, but not least, will be Victor Sauers of TKO Partners. He's a member of ERCOT. He's an engineer, has more degrees than you can imagine. And in talking to him, he's going to focus, I believe, on three things, something called, and this is what I would call it the tip of the spear, VPP, virtual power plants, as well as thermal gas used with turbines, as well as with jet engines. So with no more ado, Heather Gilker, please tell us about the project that you plan to discuss.
Sure. Thank you for having me. Thank you, Marty and Tyson. Good to see you again. I'm sorry I'm not with you today. I'm in Dallas, and I know it sounds like they're just a great bunch of people in the room, so I hope y'all are having a great time of it. I am pleased to be spending my time working on projects where I can take my expertise and my background has been as an equity analyst, as a portfolio manager inside a family office, and as an allocator. And I've done kind of a pivot. So in the last 4 or 5 years, I've pivoted more toward impact investing. So taking my skills and knowledge and helping putting entrepreneurs and founders together with investors around projects that can do things to help make this energy transition happen, to help bring impact in the world. And whether that is in clean technology or healthcare or education. The two that we could talk about today are ones where I've got my securities license, I'm helping to raise capital, and I'm excited about the prospect that in carbon capture and sequestration, there's conventional carbon capture and sequestration, and there's unconventional. And this is these are two companies that are raising capital. One is very much in venture mode, and it's raising capital to take advantage of proprietary technology that enables it to use its technology to put carbon, CO2 into coal bed seams. So coal loves CO2 and will hold it. And this is an interesting technology, proprietary. It's been around for some time, and it's just now at that moment in time where the stars are aligned. It's based in Wyoming. In Wyoming, you've got state laws that are saying that if we really want to do what we can to protect this coal-fired infrastructure, and how do we do that? We just mandate that they've got to have carbon capture to stick around for the next 5 or 10 years. And if they don't, then they've got to shut down or they've got to convert to natural gas. Natural gas is a very expensive conversion. this is another way to look at converting, where you're basically putting the CO2 in the ground and you're offsetting next to the utility plant or the cement manufacturer or the coal-fired plant. So that's one. It's a large market space, and it's got real strong IP and a commercial position. And that there's a sister company that is really good at measuring the CO2 when it's down in the space with some proprietary Raman spectrometer. And they've been providing that technology in the very classic traditional oil field service space in the Permian. And we're working to help them find a financial partner to do a roll-up and buy a couple of strategics that would enable them to control more of the operating expense and the capital budget for those specific projects. So that's what I'm working on. And I must confess, I'm a generalist. I did not spend time in the oil and gas business, but I do have a lot of respect for this team and the fact that the people who really understand carbon capture and sequestration are the people who know how to get the oil out of the ground or the natural gas out of the ground, or the people that really understand how to put it back in the ground. And then how do you measure it? How do you make sure it's not seeping over to adjacent property? All those sorts of things. So I'm having a good time working on that.
Are there any questions from the audience?
What's the size of the raise?
Oh, the size of the raise is looking to raise about 8 million for the roll up, and for the one, and that's really more growth capital. They've actually got existing revenue this year, and they're cash flow positive, and they're looking for pro forma post acquisition would be about $62 million in revenue, with some EBITDA at about 14. They've got some targets. The other one is in the venture growth phase, and they've got revenue this year of about 14 to 16 million. They've got some really interesting pilots, and they've got just a really large trajectory going forward of needing some really strong financial partners to do some project finance around these really big projects.
Who are the typical off-takers of projects like this? There must be existing off-takers or customers. Who are the
Yeah, the existing customers would be a utility, a public utility or a private utility, but basically they're looking at what does it cost me? What's the opportunity cost to convert to natural gas versus carbon capture and sequestration? It could also be cement manufacturers, and it could be other folks that are playing in that space where coal has been a really important feedstock for how they do their business, manufacturing, etc.
Heather, I'd suggest you put up your contact information in the chat space so that people can get
Sure. Okay, happy to do it.
Any last questions, or should we go on to Jennifer Warren? Jennifer Warren, what do you have to tell us about the energy transition? You have 10 minutes.
Well, I'm going to show some slides, but I'm going to come at this from, instead of like a super macro view, I'm going to come at this from some of the sort of things that I think are key right now to do with the transition, and largely regarding fossil fuels. Let me try to get my slides up here. Everyone got this? Hello?
Yep, we see it.
Is it on?
Yes, it says the color of the energy transition, a text point of view.
All right, I'm good. I didn't have the mic going. So I'm founder of Concept Elemental, the communications and advisory boutique, and I specialize in resources primarily. This is just kind of giving you an idea. So I have this public side, which is what Tyson alluded to. I started chronicling the shale booms in like 2005, and I've continued for the last 20 years. I've done a lot of publications with DCEO magazine. We've kind of hit all the the breakout stories in shale and the gas boom in 2008, and then the oil boom 2013, 2014 in the Permian, and continue to this day all the way through ESG developments, net zero, all that. And this is just a map of the United States and the shale booms. And here, right here, we've got the Permian. And this over here on the left-hand side is just a view of this ranch in the Panhandle that I did. It's one of my projects, and I'll talk about it in a minute. It's kind of one of my boots on the ground projects. Again, the Permian has kind of been where it's at for some time. It's now 6% of global oil supply. This particular story was done in 2021, and I interviewed Scott Sheffield, who was the CEO at the time, and now, as we know, Exxon has bought them for $60 billion. And what's going to be interesting is that it's really going to allow for the potential of greater resource recovery, like in shale wells. You can get anywhere from like 8 to 10%, and that doesn't sound like a lot, but that's what they're getting from the wells. And so Exxon is planning to, in fact, try to double this. So I think there's a lot that can be done, because if you think about it, over 80% of primary energy demand is met with fossil fuels. And so you've got to, if you're going to decarbonize, you've got to hit where the action is, right? And so that's kind of why I'm talking about this specifically today. Also with these deals, I counted just the big deals from, what was attracted to me, what I was attracted to, $180 billion just in the last 6 months that has been announced. And a lot of it in the Permian. Another really important big deal is the Diamondback Endeavor deal, which was $26 billion. And so with Exxon acquiring Pioneer was the largest independent in the Permian. So now it's acquired by a super major, right? And with Diamondback acquiring Endeavor was a private player. Diamondback is a publicly traded firm. Now that creates one of the largest independents in the Permian. So you still have a lot of super major action in the Permian, and then the independents. And this consolidation back in 2021, when I was interviewing Scott Sheffield, I mean, we were on the heels of the pandemic. There was still low investment in the industry. And he said at that time, we're going to see a lot of consolidation. And that is what we're seeing right now. And a lot of that, to me, is it's, capital discipline, capital efficiency, and also resource efficiency. So I think you see, the large oil and gas firms sort of doubling down on what their future value proposition is. And so I think that's really interesting. And then the other big merger was Chesapeake Southwestern, $12 billion, and it's created the largest natural gas player, which is considered by the market as like an, optimistic viewpoint. Instead of a defensive merger, it's like opportunistic. There's more to that story. Just a little bit about Texas here. It's showing there. So I can't see my own slide very well. Okay, so exports was sort of the big story here in Texas. If you look at this red line flat, that's the United States minus Texas. If you look at the blue line, that's Texas, that's exports. It's largely energy exports. We exported 20% of LNG volumes globally in 2022, and that was because of the Russia-Ukraine invasion. That's something that I speak about publicly quite a bit, is energy and geopolitics, but I'm not going to be doing that today. And the other thing I want to note, just there's so much action on the Gulf Coast. If you put Texas and Louisiana together, it's $315 billion in energy exports. It's a lot. And this bar chart up here is just showing that crude oil is the lion's share, call it like $115 billion. Natural gas liquids is next. And then the other thing just about natural gas is that supposedly natural gas peaks around 2040. That's kind of the projections. It grows until then, and it's an emerging Asia gas story. And as you can see here, even in 2040, it sort of plateaus around 10%. And there's a little more. So this is noting, this is one of the stories I mentioned I wrote in 2008. So back then, when there was a shale gas boom, everyone was talking about, well, natural gas is the way to lower emissions vis-a-vis coal. And, here we are in 2024, and we're still debating this. In Europe, they just put natural gas in their taxonomy as a decarbonization path, you know, so that's like 16 lost years in some respect. But in Texas, you know, we have a lot of renewables on our grid, and I know that we have a grid expert here in Victor. But, you know, we're actually having to add more natural gas generation just, you know, because of renewables, because of reliable base load and all that. So natural gas is a big base load player, especially if we're going to have all the, you know, quantum computing and AI and all this stuff in the cloud and the data centers, and which a lot of it's here and happening here. Yes.
Can you go back to the prior slide?
Which one?
Chart?
Oh, that one?
Right. So you're saying natural gas demand will flatten?
Well, this is,
2040?
well, that's the estimate. Like it plateaus, you know, it just plateaus. Not that it,
Because
but
the
it
world
can
becomes
still
Of
more
course
energy
it stops,
efficient.
Marty.
possibly. Well, also other sources, you know, other energy sources. Like you could get more nuclear added in. You know, if you think about it, in India and China, I mean, they're generating with a lot of coal too. So, you know, and those are their homegrown solutions, right? So
Is India a net importer of coal?
I think they produce coal.
Really?
They
I
produce.
believe. Yeah,
Big
they
producer.
Yeah. So moving on. So this is, I just want to show you this. So these jewel tones here, these are LNG import facilities. Now, look, the jewel tones are more than the warm tones. The warm tones are export. Look at where the export is. It's us, North America, right here on the coast. So that's really interesting as well. And I just want a quick note, you know, with LNG, this is from Shell, these last 4 bullets, that, you know, there's a lot of will to reduce methane emissions. You get a lot of bang for the buck with methane over CO2 even. In LNG, there are nature-based approaches via bio-LNG. That's a whole nother story because then you have to deal with feedstocks and all that. The credits is the other route, but at present, you know, there may not be enough credits in the world for all the credits that people want to use. And that gets to something I'm going to talk about in a minute. CCS is a route. And then also clean cargoes from the United States, you know, where, you know, the thought is that we will have these LNG, you know, that will be the premium LNG supplier around the world because we do produce more cleanly than other places. And this is just my natural capital practice. This is sort of something I've been developing for a while, for really the last couple of years. And it's sort of something that real near and dear to my heart. So it lends itself to, and the idea of natural capital isn't new. It's been around a long time. It's coming more in the fore in terms of sustainability initiatives and investment. And from my point of view, from my work, it lends itself to like complex and asset-rich situations and nature-based initiatives. And I have 3 projects for which I'm involved. One of which, the natural capital of a large-scale historic panhandle ranch, which I talked about in, you know, the last 2 times. That ranch, in fact, was hit by the Smoke Creek fire, and so, you know, prayers to everyone there. And in this project specifically, I assessed like the salient attributes and assets and offered expert commentary for a global marketing campaign. And then something that's coming up, and that's the Turkey Track Ranch, and I weighed in on the assets. And, after a lot of research and study and analysis over a couple of years, but preceding that, I mean, I've been working on this for like 10 or 15 years. There's a lot of theory and stuff behind it. And this is the other project that I have coming up. It's going to be a feature, and it's in the Texas Triangle area, and it's an amazing brownfield remediation story. So it's this here on the lower right is the Sansum chip plant that's being built, and originally they were estimating it to be 17 billion. Now it's like 30 billion is what it's going to cost. So these chip plants are really expensive, by the way. And there's a few more on the books in the United States. This picture on the left is the project of which I'm referring. And at one point, those lakes were in fact coal pits. And this is just another view. And it's a big reuse story, a big industrial reuse story, and it'll come out at the end of the month. And on my website, conceptelemental.com, I'll put a commentary page and I'll have some of these slides. And I also have like a video just kind of detailing some of this presentation so that I made sure I said the things I needed to say. And then this is just an aerial view of the day. I mean, I was in a helicopter all day in the middle of January doing this project. So I will stop there and thank you for having me, Marty, and for the time in my town.
Thank
Can I
you.
just have one question?
Sure.
So, I heard that there's more than enough proven oil reserves in the Americas for 100 years to supply the United States. So, I don't know. Isn't the issue just keeping that clean, or?
What do you mean keeping it clean? Like,
Well, somebody once said like 100 years of oil reserves might as well be infinity because people just keep on getting better and better at being more efficient with the oil and natural gas.
no, that's true. I mean, it's true. I mean, if you look at even before the shale booms, I mean, now we're hyper efficient. I mean, we went from producing I think it was like 4 million barrels a day in the early 2000s to 13 million barrels a day. We're almost at 13 and a half, I believe. I mean, that's a record. We've never produced that much. And we are doing it more efficiently. We're doing it with fewer rigs. We're getting more oil, the footprint size of producing is much less than it ever was. So we are getting better. And now a lot of these majors and a lot of this consolidation, is because of this efficiency and capital efficiency. So they all go hand in hand, and that's good news, right? As we find other ways to do low carbon ventures, this can complement that, because we're going to be producing these resources and using these resources. I mean, everything around us is built off fossil fuels. The city was built off fossil fuels. I mean,
it's not just the energy; it's also just petroleum products.
The products, yeah. What everything's made of.
But can I add one thing to what Jennifer said so well? I think also, we have to remember that Texas generates more electricity from wind and sun than any other state, and has since 2006.
Absolutely.
And so that's going to continue. And Exxon and others are using wind and solar to supplement their needs in the Permian. And it all can go hand in hand, and we're going to need all of it because our population is growing. We invited the Bitcoin people to town and said it'll be really cheap. We're going to give you some really great rates on electricity. And now there's some controversy. The neighbors are saying they're not the best neighbors, and they're sucking up a lot of electricity, and they're causing all my rates to go up. And that'll be some issue that somebody's gonna have to deal with. But we're using more electricity, we're gaining more population, and we're gonna need to have all of this stuff.
Well, Heather, I'll give you another one. Before I sat on this panel 15 minutes ago, we were generating 29 gigawatt of renewables in the state of Texas. At the same time, I looked at California on their peak load for the whole state. It's 25 gigawatt. So we can power up all of California just with our renewables right now and have a surplus.
Yeah.
But there's another reason
And we
that
get
I'll wait for my turn.
sunshine in the sunshine. West Texas gets more sunshine than the old Sunshine State. So we have all the tools and all the toys to play with. We just need to take advantage of them.
There's no hydropower in Texas, is that correct?
A very small amount.
Very negligible.
Because California is abandoning its hydropower, right? So,
Yeah, they
Hey,
stopped
Marty?
about 20 years ago.
Tyson.
Marty, I'd like to say one thing. So the estimated transition from fossil fuels to renewables is about $62 trillion. And I just want to show one slide as it relates to natural gas. So Jennifer, if you could stop sharing your screen, I can put it up. And it's from EQT. And what EQT is saying, and I've believed this for a while, about to share it, hold on. This will give, can you all see this screen?
Yes.
Yes.
Okay, what that says is there is a argument that natural gas is the most efficient way to bring down carbon of anything. And what this EQT presentation this week shows is how much CO2 reductions will occur from the build out of LNG, and then it compares it to the carbon reductions that you will see. So what is intended with all these large acquisitions we just saw is that all that carbon emission reduction of turning 100% of the US car fleet electric, to powering every home with solar rooftop panels, and to adding 54,000 windmills, doubling US wind capacity, will do just as much as if we simply increase LNG. And what we see from Exxon, Chevron, Endeavor, Chesapeake, EQT, Tokyo Gas buying Rockcliffe, everyone wants to scale the natural gas and turn it into LNG, because as we displace the coal-fired plants in China and India, we will get to net zero 50 by 2050 faster than all of these huge renewable solutions. I think the rational viewpoint is that it's all of the above, but people don't really sometimes appreciate the relationship between renewables and natural gas. And what you just saw, Jennifer, highlighted about $200 billion in acquisitions in the last 6 months. And there is a big trend. So our next speaker is going to talk further about that. This is Bate. And Bate, please tell us about, you gave it to me, now I don't have it.
No worries, I can do it. Yeah, thank you, Tyson, for the intro. Jennifer, excellent lead-in, as always. So, EP Valuation, my firm does due diligence. We provide asset valuation and ESG reviews for financial firms, operating partners, and investors in the energy space, right? So the work we do enables our partners and our clients to make effective lending and investment decisions in what is increasingly a challenging energy landscape. In the past 3 years, we have performed over 200 valuations on deals ranging from $525 million on the small side to about $5 billion on the large side. Now, some have been larger, but of course the larger deals are fewer. Most of the work we do is within that range. Now, personally, I'm a registered professional engineer in Texas with an MBA from UT Dallas and a bachelor's degree from Montana Tech, and I hold a certificate in ESG and sustainable capitalism from UC Berkeley. And I've been in this space for about 22 years. Now, turning to ESG, I would say that based on the deals that we have been directly involved in, the trend in energy generally has gone towards transparency. So by year-end 23, nearly 85% of E&P companies presenting to investors had an ESG slide in their presentation. And that is up from about 10% in 2010. Right? So there's a tremendous awareness of ESG in the space today than has been in the past few years. The challenge that we see in our clients and where we make a difference is verification, right? So companies self-report, and as you all know, there is very limited public or private data to verify these disclosures, which means that when a deal is at stake, we often get invited and get asked to verify these ESG targets. Is a company able to accomplish what they're stating, and how will they know if that's actually done? So we do that kind of work to help our clients verify that their investments and those they invest in will meet those targets. Now, we encourage some of the banks and financial entities we work with to encourage E&P companies to meet these targets by providing, say, 25 bips off the pricing grid, right? Once those targets are met. Now, some banks are open to that, not all, but we're making progress in that regard. The question I often encounter, I would say, people ask the question, how can E&P companies meet these targets without significant capital investments? And often, in our experience, the answer has been partnerships. And I'll talk about a few partnerships that are formed recently or that are forming. I have a client that has invested in Bitcoin mining. So, and by invest, I mean they have, I'm sorry, the phone is going off here. Give me a second. My client has made a partnership with a Bitcoin miner, right? So they bought an asset with stranded gas, no pipeline for the gas. Rather than build a pipeline for low volume gas, they partnered with the Bitcoin miner, brought the skid on location, and reduced flaring by about 80%, right? Now, they sold the gas for about $1 plus, so they were not making money on the gas, but they were making significant headway in reducing emissions. And for the Bitcoin miner, that is tremendous value, right? Because as you know, Bitcoin hit a record yesterday or the day before. And so it makes sense on both sides, right? To partner with dry gas producers who don't want to put a pipeline or who are flaring. And we're currently working with 3 Bitcoin mining companies to marry them with E&P companies that have gas to spare. And as many of you already know, if you are in New Mexico right now, you're flaring gas because a few plants are shut down and there's just so much oil production, the associated gas has no place to go. And so it's a natural fit for a lot of Bitcoin miners. So we're seeing a lot of movement in that direction, which makes sense. I mean, Texas has that to provide, so does New Mexico. The other thing we tell our clients and E&P partners is they can make direct investments where necessary in renewable companies. As you all know, there are tech companies in our space that are doing tremendous work in coming up with low density, low carbon fuels, high density, low carbon fuels. And I'll give you a few. But first, disclaimer, the companies I'll name I don't work for, we don't have business with, but the companies that are making room in, headway in this space, I'm just gonna, share a few names. And the few, more companies that I'll discuss, but for the sake of time. So there's a Finnish company called Neste. Big company, has been around a long time, since the 40s. It used to be a refining company in Finland. And in the past 15, 16 years, they've transformed themselves into a renewable company. So Neste currently converts vegetable oils and waste fats into high quality, low carbon fuel. And their product, which is commercial, has an up to 90% lower carbon footprint than traditional diesel. They also make jet fuel. Neste sells its fuel to the city of Oakland in California, the Chicago Cubs, JetBlue, and FinRa. Right? So this is not a trial company. They have a product that works. They have a product that is commercial. Another company in this space, similar trend, is Gevo. Gevo is based in Colorado. GEVO. It's based in Colorado, and they also turn corn and biomass into gasoline and jet fuel. The concept is proven. They're scaling up, so much so that recently they signed a deal with FinRa to sell 7 million gallons of jet fuel per year at $5.50 per gallon, about. Now, in terms of just benchmarking, traditional jet fuel sells for anywhere from $4 to $10 per gallon, depending on energy prices. So this is a commercial deal. It's a profitable deal, and they can do so at scale. There's another company called 12th that's California-based. 12th does something slightly different. 12th replicates photosynthesis at an industrial level. So rather than use vegetable oils or biomass, 12th has a process that converts CO2 back into methane, ethane, ethanol, and jet fuel, right? So you're really going from, CCUS back to traditional fuels, right? Except with an 80% lower carbon footprint. And I think this 12 brings together a concept that if it's scaled up, would make a difference, especially in Texas, where we have so many CCUS companies setting up, right? We have all these reservoirs where we're going to store captured carbon. And now you have a natural feedstock for a company like 12 to create lower carbon fuels. And 12 has sold its product to Alaska Airlines, to Microsoft, to San Fran Airport. I bring this up because airlines are very conservative in what they put in the engines, right? Because nobody wants the headline of a plane dropping out of the sky, right? So when you see headlines buying, high density aviation fuel, which has extremely low carbon content, you know that they've been tested, they feel confident about it, enough to put passengers on it. So these are companies that are making headway in this space. And there's another company I'll just mention real quick, and this company is called Enapter. Enapter is a German company that makes electrolyzers to produce green hydrogen. They have a modular product that can be scaled up, and their goal is to reduce the cost and therefore the adoption of green hydrogen as a primary fuel. Because as you know, all it's expensive to produce hydrogen today, green hydrogen. So again, their process is proven, but they had a lot of difficulty raising capital over the past few years. I think it took them quite a while to raise 150 million or so 2-3 years ago. I say this because I work with E&P companies all day long, right? A shale well is $8 to $10 million, right? So an investment in a company like Enapter is what, 5 shale wells? And you extend the runway of an E&P company from being just an oil and gas company to an energy company that is mostly oil and gas, but increasingly able to provide renewable or resources towards renewable energy. Because as we know, there'll be another downturn, and we need to position ourselves, E&P companies that is, set themselves up to have multiple revenue streams going forward. And in a year, when we're making record profit, 2023 was a great year for oil and gas companies, and so will 24B. We encourage our clients to think about partnering and investing in these tech companies that are cracking the code on low carbon, high density fuels. Because we think that while they cannot replace oil and gas, they are making headway, and increasingly we change the mix of fuels that the world runs on. So I'll stop there and maybe take some questions as we go.
Thank you, Bate. Questions?
I just want to say that it's a really great presentation, Bate, and you're absolutely right. Just reducing the mix, even in the fossil fuel stream, and making it cleaner is headway, and it's a real way forward, like you say, and it's realistic and incremental in terms of capital efficiency, and it does head towards a cleaner future. So hats off.
Yeah, absolutely.
Can I just raise a point about something that Tyson said earlier about China and India versus all of our efforts to make everything cleaner, which is that there was a study done by an Italian economist and looking at Chinese production of solar panels. So back in the early 2000s, most solar panels were produced by Germany using natural gas. Almost all of today's solar panels in China, which is about 95% of the market, are produced using coal. But China gets the exact same tax credits for their production of dirty solar panels that were in Germany. Whatever the global governance group is that looks at this thing, never changed their model to account for production via coal.
Yeah, whole supply chain life cycle. If you look at the supply chain life cycle of everything, you'll see that a lot of the greenest things with renewables, they're on parity with fossil fuels in some respect. So that is the great missing narrative, and
the greenwashing.
And people don't want to cross the narrative, and that's what I speak about till I'm blue in the face a lot.
Yep, it's just food for thought.
Yeah.
So Victor Sauers, please tell us, what are some of the technologies so that we have a better view of where the growth are? You mentioned 3 technologies at what I like to call the tip of the spear, because family offices, wealthy individuals want to be where the growth is, where the scientific innovation is. And you understand that and how it all connects to the grid and becomes a reality. Fire away.
Well, the growth is huge, and opportunity is even bigger. We heard our economic presentation this morning, both internationally and domestic, and that is a leverage point going into this conversation, where we see in the U.S. an enormous amount of onshoring of manufacturing and energy products and Bitcoin, AI, all these large loads. So in the next 15, 20 years, we're looking at the, if we're able to accommodate it, to increase the US grid by a good 40%. Now, can we get there in that short amount of time? It's questionable, but we break it down a little bit more, and let's talk about, since we're having this conversation in Texas, let's look at Texas. Texas is projected to grow, as far as load, 19 gigawatt in 2.5 years. The low estimate is 15 gigawatt. And if everybody wrap their arms what a gigawatt is, that's one nuclear power plant, 200,000 homes. So last summer in Texas, August, July, each evening when our renewables went to sleep, when wind gets a very hot atmosphere, we're like 107 degrees, wind doesn't blow very well, and then it gets dark. So something has to do that 5-hour gap. So what do? It was sketchy. We had a couple of days it was very sketchy. But it's also, if you look at 19 gigawatt, it's a $500 billion economic growth opportunity for the state of Texas. So if I have these large loads, Bitcoin, AI, semiconductor, where I want to go? I'm going to go to California. They have capacity, but the regulatory environment is toxic. So where else do I go? I mean, New Mexico is 9 gigawatt maxed, and we have 19 coming our way on top of what we are. We're at 90 gigawatt, including spinning reserve right now in the summer. You had 19 on top of that. We're as big as the next 20 states combined. So are we going to miss this opportunity? Do we need natural gas? Yes, but to have what we call a combined cycle power plant of natural gas, you have to have water. We haven't done water infrastructure since 1956. So peakers don't run on water. They're not efficient, and they're about 300 megawatts, small units. There's only one large unit that we might get in 2028 out of the old Alcoa plant in Rockdale, Texas. And the reason Rockdale, Texas is interesting is the last non-permitted, first permit water in the state of Texas that's left. So for me to fund a power plant, that developer has to show me they got first permit rights to water to do a combined cycle. You got to have A to get B. So we're in a bit of a pickle. So we are going to need energy storage, and we've grown. We went from like 0.5 gigawatt of storage in the state of Texas, batteries, what have you. Now we're 6 gigawatt, and we're projected to be maybe 11 gigawatt by December. But then again, batteries are great, but it's also a load. So now you're adding 11 gigawatt load at some time during the day. And so do we supercharge solar development to actually charge the battery during the day? Maybe, right? Do we need combined cycle? Do we need peakers? Yes. And we only have 2.5 years to make something happen. One of the elements on the technology kind of part that Tyson and I talked about was virtual power plants. And there's different kinds of meaning behind that. It can be a virtual power plant is an aggregation of, let's say, 100,000 homes. I now control your thermostat or your appliances. Or I take the next step up and we do like a Tesla program on the Powerwall where, you know what, I control your battery in the garage and your appliances. Now, when you get to a certain size, and it's very limited on the pilot programs that are currently going on for virtual power plants in Texas, because it's an energy market and allows an enormous amount of flexibility to do experimentation compared to other grids. Texas is an independent grid. It's not part of the federal government. Other states are combined in 13 state segments, blocks. And it's very difficult to get things going at the federal level because now they're under federal command. They do an experiment on some sort of innovation, like a different kind of virtual power plant. But right now, the Texas PUC, the ERCOT leadership, and all the stakeholders said, you know what, it's all in. We have to do everything and we have to be quick. We need gigawatts of power. If we don't do anything, any additional load, we need to do something. But it's a great opportunity. It's a great opportunity where we're looking at ConnectX. ConnectX is looking at something where it's using AI to be able to do control loads and aggregation in the millions of homes, to be able to support the grid during times of critical need, right? Are we able to do power walls in the hundreds of thousands in the next 2 years? What's the incentive when you have 7% interest rate? It can be kind of difficult. Power walls is about $11,000 install, right, per residential home. But the upside is there's some homes that had the power wall this last summer. They're in peak hours, which is the best time to sell energy in their battery, and they're making $150 a night, right? Times 30. So you almost paid off between sometimes in winter, because our winter load is actually bigger than our summer load. And so you can pay it off maybe in 2 years, right? So, but the question is, what is the motivator, like a cell phone, that transmission goes from your rotary phone to a cell phone, right? How does the developers, the refi people included, is there incentives to say, you know what, we'll refi your home. I know it's 7% interest, but we'll do 4% if you do a power wall or an energy storage in your garage, right? So it's thinking a little bit outside the box when it comes to regulatory opportunity. So any kind of investment arm that has a regulatory capability is going to be in front of the game when it comes to technologies and execution capital for a more stable return. We did the same thing. We wrote the rules for wind in Texas, which was first in. We have 38 gigawatt of wind, 22 of solar. Solar is really new in Texas. It's only 5 years old. Now, other cities like Austin, where we're speaking from right now, is independent from the Texas grid. It's a little island. Same thing with San Antonio. Now, they did small little solars, like 30 gigawatt of 40 or 40 megawatts, small little ones. But once it became that this is how solar makes money, then that Texas went through the roof in gigawatts. And we did that on purpose, both for wind and solar, not because of green, because we needed something to bring down the wholesale power for our ratepayers. We're doing $80 a megawatt cost wholesale. When we started getting penetration in wind, which was first up, our wholesale went from $80 to $25. We had negative pricing this morning at the ERCOT grid. It was negative $7. And that's not good when you try and do an investment on upgrades. It gives you the power that's so too much renewables can be painful and price goes up, like California, average price 22 cents. Average price in Texas is 10. My industrial rates are 3 cents per kWh. Give you an idea. So there's a huge amount of opportunity to say the Texas power sector, both from the regulatory body, the legislative, the PUC, ERCOT, and the stakeholders, is open for business in a big way. So I wish I could do a bunch of gas power plants. Yes, it is better than coal by far, and it does base power, which we need, and it's cheaper than energy storage, and it's not a load, it's a pure play generator. But it takes me 3 to 4 years. If I did the purchase order today, I won't get it until 3.5 years from now, right? And that's if I have water and a location. So, matter of fact, the old Keller plant with this gas power plant, combined cycles being built, used to be a lignite coal burning plant with 4 power plants on site. They sold them all 4 to China. They stripped it down because Alcoa shut down the location. It's 32,000 acres, mostly for strip mining for lignite to power the power plant. So they're running a gas line and turning it into a natural gas power plant, which we need. But you're looking at from a climate change standpoint, with kind of like what Marta's talking about. If US was 0, I got China, India, and I got African nations going nuts on coal. We're going to increase emissions by 20x emissions. So if we're worried about CO2 and 2%, well, guess what? We're going to hit that 100%. But at the same token, if we want to maintain an 8 billion population, and you have 4 billion people that are trying really hard to get the First Nation status, which means they're going from 4 metric ton living to US 17 metric ton living, That's increasing the population by 16 billion people. So when we run all this information through regenerative AI, and I also have an AI company outside of Tico Energy Capital, had it for the last 15 years. When we punch in all the information, including my peers have their AI, and the regenerative thinking, it says you must increase CO2 because we need more humidity and we need plant food, which is CO2. If you want to maintain 8 billion people, so be careful what you ask for. The AI might give you the answer. So that kind of puts things on its head, right? Now, would the whole world look like Florida in a bad day? Yeah, it would, but plants will love it.
You get 3
So you
minutes.
have to
Victor.
choose. Yeah, so I think the opportunity, not just in Texas, but these kind of technologies, a virtual power plant will work on other U.S. grids like PJM. PJM cannot take any more renewable projects. Give you an idea, we're backlogged 1.2 terawatt of renewable projects, and it would take me 30 years to get rid of that backlog. So if I'm doing 40 gigawatt of installation in the U.S., it'll take me 30 years to get rid of that backlog. So where do you want to put your capital, right? At the same token, in a shorter time, we're having a huge opportunity to reshore manufacturing, reshore a lot of our technology, and accelerate our Bitcoin, and also more importantly, our AI. An AI chip is like 30,000 chips, like in a data center. The power for an AI is 700 watt. So if you ever go in your backyard and turn on your floodlight, that's 100 watt. That little chip that's the size of my thumb is 700 watt times 30,000. That's a huge, huge load. Now we call it machine-to-machine regenerative thinking because it was before the popular name of AI, to do our analysis on energy and how technology can impact, like virtual power plants, like storage, wind, on and on. But everything that we've seen on AI technology has been a mechanism that dumb it down for humans to understand. So if you look at even your ChatGPT, I think beta is 4.5 and 4 is commercial. I mean, it's not that smart. It's not very regenerative yet, or any other kind of AI. It's not there yet. Machine-machine is outstanding, right? Faster than you think and faster than you can understand. Our program that we do as a fishtail into the program is so we can understand it because it goes so fast, right? When you do AI, what you're really saying is, I'm trying to understand machine-machine intelligence as a human. And we're not that smart, and we're really, really slow. So you have to ask yourself, we're using an enormous amount of power for the convenience of understanding machine-machine intelligence. And that's after reviewing about 26 AI platforms. So you really, really need to think about what this is all about. Anyway.
Thank you, Victor. Do we have questions?
I just had like an AI comment, but it's kind of a question too. So my daughter is a software engineer and works in the domain. And we were discussing this last night because of all the blockchain conversations and Bitcoin mining conversations we had yesterday. AI and machine learning is backed by linear algebra, which entails incredibly computationally expensive operations on massive data sets. And it is a power hog. So that's the limiting factor on AI is power. That is why AI gravitates to power. That's why Bitcoin miners gravitate to energy. You know, so I find it all really ironic in some respects. I mean, it's a bit of a, I'm throwing a wet blanket, but it's the reality of the physics of the world, you know. And so our—
Are you saying that most of the AI data centers will be located in Texas?
I hope not.
So if you need a gigawatt of opportunity, manufacturing, even a lifestyle center, you want to build a small little city, right? Where are you going to get a gigawatt in the United States that's available? Where?
Texas.
Only Texas.
Yeah.
Oh, there's the Dakotas.
No.
They're very windy.
Well, they're windy, but the infrastructure is extremely light.
They could suck up all the stranded assets off of the edge of the Bakken.
Yeah, it's a small load, and it's mostly coal.
Don't drive a Tesla in Montana.
Great guys, I know them all, and I know all the utility guys.
More questions? Marty, are there more
I
questions?
think we're really great with the final remark of don't drive a Tesla in Montana. So,
That's a quote from an interview I did with Jay Hatfield, who runs a MLP ETF, and it's
fantastic.
Thank you.
Well, great job.